Bismillahirrahmanirrahim. In this Reader's Guide third part, we will cover the last half of Chapter 1 in our ongoing online reading course on Goodhart's book on the evolution of central banking. So, continuing from last time, the responsibility that central banks have today was not given to them at the outset. Rather, once they became powerful, then they recognized that they had a responsibility to use this power in a good way. In particular, it emerged that they could not act competitively without actually causing damage to the system. They eventually learned that the big banks had two types of responsibilities. One of them is macro management, which is concerned with the state of the economy, employment, productivity, but more directly exchange rates and stability of the currency. So these are the macroeconomy issues, but they also had simultaneously to undertake regulation and supervision of the banking system. So this was the micro responsibilities. These responsibilities of banks changed from time to time. Under the gold standard, which was maintained until the First World War started in 1914, the main responsibility of the central bank was to ensure the stability of the money by making sure that there were adequate gold reserves and the money supply was not expanded beyond the availability of the gold backing. In the post-World War I, this gold standard broke down and there was a fairly chaotic system in which the needs of the domestic economy were prioritized over foreign trade. Post-World War II, the Bretton Woods system was created, which was trying to manage a fixed exchange rate standard without gold, and the gold was replaced by dollar, and technically dollars were exchangeable for gold. So this was called a gold exchange standard. Then in 1971, Nixon shock destroyed the gold backing and led to the world of floating exchange rates. This completely eliminated one type of responsibility, which was to maintain a fixed exchange rate, and led to reconceptualization of what a central bank is supposed to do. But this is just a brief sketch. We will go into detail on this later in the book. But throughout all of these changes, one thing remained the same. The central bank remained responsible for the smooth operation of the financial system. What this means is that the micro function, supervision and regulation of banking, is actually the central principle of central banks. This is the central purpose. And this is the macro management emerges as a secondary issue. This is the opposite of the textbook picture, according to which central banks maintain a main function is monetary policy. If these micro functions are the main reason for existence for central banks, then they are needed regardless of whether or not monetary management is done. So there is a big debate about whether or not one should do monetary management, and if so, how. But all of these questions are irrelevant for the point of view of existence of central banks, because central banks are needed to regulate and supervise the banking system. Furthermore, there is a large amount of interaction between the micro function and the macro function, because when the central bank acts as a lender of last resort, it bails banks out in times of crisis. This is some kind of insurance. This can be more or less. But insurance automatically leads to moral hazard. The banks will now take gambles because they know that there is a backup available. And the more we insure the banks, the greater the moral hazard and the greater the possibility of crisis, And this is not just a theoretical possibility. The empirical experience shows that if you give the banks opportunity to gamble, they will take this opportunity, and they will take benefit of this insurance. So the micro function is directly related to the macro function. If you do badly on the micro level in supervision and management, you will create crises. And so there is a need to connect these two functions, even the supervision and regulation with the macro management. This is not done mostly in the world, around the world today, because even when you have a bank in which both things are being done, they are done by separate departments and don't have much connection with each other. So we come to the historical experience which led to the creation of the supervision and regulation capabilities of the central banks. And the book goes through a large number of historical experiences which show that this emerged out of experience. It was not planned. So for example, the 1844 Bank of England divides the bank into two parts. One is for stability of currency, and the other is just a private commercial bank, just like the others. So it was a competitor in the market. This was a mistake, a theoretical mistake, because as we learned from historical experience, a bank which is the lender of last resort cannot be a competitor, because it has conflict of interest. If a bank in crisis applies for a bailout emergency loan, as a competitor, the Bank of England would want to let it drown so as to reduce competition. But as the central bank, it has the responsibility to save the bank. So because of this conflict of interest, the central bank cannot be a commercial bank like the other banks. So the book goes through an analysis of the historical experience, and it shows how many banks, central banks, started out as private banks and remained as competitive banks until unpleasant historical experience taught them that this is not permissible. And so eventually everywhere the central banks abandoned the role of private banking, and they became solely a banker's bank, only for use by banks. And over the European experience, there were many different pathways to this realization. And according to the path also, different kinds of partitions emerged between the supervision and the regulation functions. So there is a large variety of possibilities as to how to do these two functions, and they are shown in the institutional structures that you see in European banks and now all over the world. So the question of interest that remains is, how should these two activities, micromanagement and macro management, be carried out? They could be done separately in different institutions or in same institutions. So this issue is not going to be explored in this book, even though it is of great interest. Rather, this book is concerned with the theoretical and empirical reasons for existence of central bank. In the 19th century, the discussion was mainly about, are central banks necessary, in the sense that if we just had a clearinghouse where the banks could swap their checks, the interbank clearing mechanism, which is actually implemented within the central bank these days everywhere in the world. If there was no central bank, but there was just a central clearinghouse, would that be enough to create a stable monetary system? And the empirical answer to this is no. Experiments of this kind have been tried and they have failed. The private banking system without any supervision and guidance just turns out to be too unstable. The 20th century discussion on the same issue of what the central bank's role is focuses on asymmetric information. Banks have private banks have the incentive to hide the true status of their loans and their risks from the private investors and depositors, because they would like to take risk, but they would also not like to reveal this risk to their. So there's also the moral hazard issue, which we have already discussed, and the insurance issue. and all of these lead to fairly constant market failures, which we see from time to time in the Great Depression and in the numerous, more than 100 banking crises. So the issue is, how can the central bank reduce these market failures?